All right, let's get started. Okay. All right, when I am mapping out a measured move, so there's a lot of factors that come into play, and I'm just going to use SPY just to start with. I'll do a couple, and I'll do a couple across different time frames, but I'll use SPY just because it's a ticker that everyone's familiar with. And I'll start it off as a swing trade just because that's something that we've been working with a lot, over the last few weeks. So I'm just going to build on top of that what we've been working with. So what I like to do is when I'm looking at a move, right? When I'm looking at a potential measured move or what I could expect, let's say we're working with a week-long time frame. So what I'll do is I'll hop on a weekly chart, let's say, right? And I'll take a look at what have been the averages across, maybe a 90-day time frame, a quarterly time frame, and just get a range, some kind of range to at least give me some idea. So let's just take a look at what we've had, recently over, say, the last 90 days, let's say. Obviously, this one is a little bit more intense because of the CPI data, but you can already look at this chart without me even saying anything and already get somewhat of a gauge of what kind of distance you can expect to travel in a week. Like SPY's not like this move right here, this like 12% move. It's uncommon. Like we've only had two of these kind of moves this year, but it's uncommon to see a move that massive. So like if you're basing your expected move on an extreme, you're going to be upset, right? So what you want to do is you want to take an average. So let's just start with this week. Let's just go look at 624. So 624, it opened up at, if you were looking in the top of my screen right here on the left, open, high, low, close numbers are here in the top left. So just so you know what I'm looking at as I'm reading it to you. So it opened at let's call it 372, right? It opened at 372 and it had a high of 390 and it ended up closing at 390, right? Okay, so we got we got an 18. I'm gonna put these values out on paper actually as I'm gonna do this live with you. So you had an $18 move in that week, right? So on this week, opened up at 391. Had a high of 393, right? Ticked up just a little bit, and then had a low of 372, and it closed at 381, basically at the halfway point. So what I would do in this scenario, right, is like to again measure that move. I would take my high and low values, right, and I would I'd subtract those from each other. Okay, so we have 393, 372. So those are my values here, and I'm just doing that, adding these up, and then I'm using the previous value, right, from the week before, which was 18. Okay, all right, and then we go, let's say, look at the next week, the following week, and we'll look at our again our high and low of the week. So 390 to 373. Okay, so another $17 move there, right? Okay. One second. Just pausing real quick. I'm here, just not sure where to message the bot. We can take care of that. Okay, got it. All right, so we had a $17 move on that week. Then we look at the next week, right? And we have what? We have a high of 386, or let's call it 387, and a low of 371. Is that what that is? Yeah, 371. Okay, so $15 move on that week, right? So then we'll follow up with the next week, where we have a low of 380.66 and a high of 418. So okay, we have let's just round it up and we'll call that one a $20 move, right? So then I'll take these values, right? So I got 15, I got 15, I got 17, I got 18, I got 20. We can even look back, one more week just to get one more gauge, high and low, another $20 move, right? Okay, so have a $20 range there. So what I'll do is I'll take these values, right? I'll take these values over my sample, and you can keep doing this and just to get it even more of a gauge, but the depends on your time frame and what you're trading on, right? But if you're going to do, like, let's say weekly swings, right, which is what we're kind of focusing on right now, like let's say you were looking for like a week-long swing on this. So let me just do a quick math. Okay, 21. All right, so just going to do a quick math. 21 plus 18 plus 17, 17 plus 15 plus 20 plus 20. Okay, so I took those weeks, right, and I took a 6-week sample, so I got 111, and I'm going to divide that up by 6. Divide that up by 6. Okay, so that, and then divide it by 6. So what I'm doing is I took the average of this 6-week sample, right, and I averaged it out so I can get somewhat of a gauge of an expected move, and that average comes out to 18.5. Okay, so right now we're seeing roughly every week about an $18.5 move, and if you keep doing this going back over the last over these months, you're seeing still a similar kind of move, week to week. Obviously the environment changes over time, so I like to use what's most current, and recent. But extreme moves like this, I don't like to give them too much weight. And I can look at them, but I'm not gonna expect that big of a move because it's really large, right? So, but for right now, we'll just focus on these weeks right here after this big move, right? So we got an $18.5 average. So then at that point, right, I have some gauge, right? And now if you've watched my videos on supply and demand, right? If you watch those videos on supply and demand, and how I map my zones, from that point, we can take an estimate of what would be a move, from week to week. What could we expect, and then trade, from where we are. All right. So if we're up here at 400, and let's say we're gonna make a move to the downside, right? So what would be an expected move for the week? Well, I would just take my average. I take my average, and then I'd take 18.5 out of that. I take 18.5 out of that, right? So that'd give me roughly what, 381. 381.5. Okay, that's what we would come out with, right? So, and that would give us a target price to maybe close the week out, maybe somewhere down here in this range. Okay, so maybe this is our range, which happens to be our supply zone here as well, our micro supply. So we're targeting this range. End of the week is here, 729. So we would be targeting this range like so, okay? And that would be a realistic target, especially when it's moving to the downside. Bulls take the stairs, bears typically take the elevator, so it typically moves faster. So you might even get a little bit more out of that, right? So you could, maybe like this would be an average range, and then maybe like an extreme maybe might see something down here, like that underneath. But we'll just focus on the average, and we can select strikes accordingly, right? So if we're expecting a potential of an $18.5 move, there's a couple ways that you can do it, and this is going to depend on your personal risk tolerance and trading style. So I'll tell you what I do and how I make a play on this, and then you can then use that information to apply it to your own methods and risk tolerance. Me personally, I've studied weekly expirations on SPY hundreds of times, okay? And I'll just save you the headache of doing the study. Anything beyond, like in this current environment right now that we're in, anything beyond like $10 out of the money, okay, like let's say it'd be like 390 for example, because we started at 400. anything beyond like 390, you start flirting with this like danger zone when it comes to your strike. Because let's say, all right, here's you're targeting with a strike 390. Let's say you're going, down here at like 385, and you're, taking a target like this that's a little bit deep. It's not that it can't make the move. Obviously, you've seen it do it. You just saw it happen over these sessions in the last week, right? Last week's worth of sessions. But it's not that it can't make it. The problem is I'm just gonna zoom out and just give you just a quick drawing. The problem is when you select a strike that's too deep, and this happens for day trading, and it does the same thing for swing trading. You select a strike that's close to the money, and it just starts moving in your favor. It's gonna the equity curve is gonna look like this. Okay, it's gonna be a nice, clean, and healthy, 45-degree equity curve, right? As you go deeper, what's going to happen is the equity curve will start to shift like this instead. And if you go really deep, it's going to look like something like this, okay? And that's and then it will, even potentially go like this, where it ends up reversing on you and expiring worthless because of a minor price fluctuation. So you don't want to aim too deep, because what's going to happen is, one, if you're aiming on like a deep strike, we're just going to focus on our example here. Let's say where our measured move is 18.5, and you're aiming for a 380 strike for this week. It could be potentially too deep, because what might happen is by Friday you get down here to like 382 and you're $2 away from your strike, but the whole week you've been riding this kind of equity curve where you're just like getting chewed out by theta, and then in the last 30 minutes of the day it does this. You don't want that. You don't want this kind of equity curve. Like it's a terrible experience. You don't want to have this kind of look. Okay, it's terrible. What you want is either, if you're a little bit more open to risk, you want, maybe something like this that just keeps climbing as the week goes on. Or if you want something safer, you go for a nice 45-degree equity curve that's going to look just like this as the week or day or month progresses. It doesn't matter what time frame you're playing on. The principles that I'm explaining to you right now, they apply across the board. So you can use these principles to apply it to any time frame. Okay, it doesn't matter whether you're like I said, whether you're focused on monthlies, quarterlies, weeklies, dailies, hourly, 15-minute, doesn't matter. It's, you have to have the understanding of how much distance is appropriate to travel in a given time frame. What's an appropriate distance, and then making that strike selection based on that distance. Okay, so like for me, how I would play like something like this, like let's say I was running a weekly swing, and I'm like, okay, I'm at 400 and I want to target like 381.5. Okay, me personally, I'm gonna go for like a 390, 392 strike, something like that, because I already know without saying anything that SPY in this environment on average moves about $5 to $7 in any direction in a day. And you can take that measured move and you can, look at that, what I just said, over the course of the last 7 months and see how that works out perfectly. So SPY makes about a $5 to $7 move in a day. So if I'm going to go 390, 392, I can get there in one day, like it just did on Friday. Like I can go there in one move, right? And then from there, if I make that, SPY makes that move in my favor and I'm correct, at that point, and it's moving in my favor and it's going down this, making its run down towards my target, my strike is nice and deep in the money, and my equity curve is going to be beautiful. It's going to look just like this. It's going to go just like that. And even when we get all the way down into this expiration date, I'm so deep in the money that any little minor price fluctuation, it's the only thing it's going to do to my curve. It's either going to go like this or like that. It's not going to be something like this. That's not going to happen. it's gonna either go like this or go like that. You know, maybe a little bit to the upside, maybe a little to the downside, but it's not gonna have a massive fluctuation in premium price. Okay, me personally, I like to aim at about the halfway point. That's what in terms of strike selection. So if I'm aiming, let's say on this weekly swing, it's 18.5. Like I mentioned to you, I might aim for like a $9 or $10 out of the money strike, right? Because that'd be about halfway of our implied measure or our expected measured move. Okay, if I'm day trading, right? Let's say I'm day trading, I know that SPY typically makes a $5 to $7 move in one day. So what's my, you know, if I'm day trading, I might go for like a strike. If I'm up here at 400, my maximum, now I'm giving you maximums, by the way, my maximum would be like a $3 move, you know, so I might aim for like, you know, I might aim for like a 397 strike, maximum like 396, like $3-4, because spot, and that's assuming I got in like I did on Friday, like at the best spot. But like, let's say I got in late, maybe it hit 400 and tagged and bounced like this, and then it came back to 399. Well, I'm not gonna then add 3 or -3 from 399, because remember our measured move is $5 to $7. Because if I go from 399 and I add 3 to it, then now I'm looking at 396, and that's too deep. Because remember, or not too deep, but it could be potentially too deep. So I would want to look at, you know, something a little bit tighter, like a 390, 397. You know, I maybe go $2 out of the money because it's already moved $1. You understand what I'm saying? It's already moved $1. So I'm not going to go for my maximum value because it's already moved $1, and now my expected move might be only $3-4 more from there, maybe $5. So if I go -3 from that point, maybe SPY taps out. You know, it already moved $1, then maybe it moves 4 more, right? Now I'm in a strike that's 396, I'm down here, but then at the end, let's just say this didn't occur, at the end of the day, it pulls one of these from this point, and then my strike expires worthless. You know, and my position goes from plus 300% to negative 80% in 2 minutes. You know, and then you don't want that. You know, it's an ugly move. So, you know, so these same principles again can be applied, you know, to day trading as well. So same thing, you know, if SPY's moving say $5 to $7, I might go at a maximum value, maybe $3. If I'm expecting a big move, it depends. That just depends on how the price action is of the day. You know, like I'm not gonna take I'll just give you an example, right? Like if I go on a day that's like, you know, like something like this, right? If I start the day out and it's doing this kind of stuff, I'm not gonna go for like a $3 out of the money option. I'm gonna go for like maybe a at the money or $1 tops maximum. You know, it depends on the price action, right? But I'm just giving you a general guideline of how to use measured moves in your favor, right? And you can see how SPY moves in this environment. It's $5 to $7 every single day. You know, up and down, up and down, up and down, up and down. You know, like it's like that's the average. You know, like that's the average move on the day. So, you know, and then you can use that, obviously the same thing I just mentioned for weeklies. You can do the same thing for monthlies, right? If you want to look at it on a monthly time frame, right? So let me get rid of these guys. You know, it's the same principles, you know, so you'll take your sample size over a series of months, right? So like this, you can say, okay, let's look at the last, I don't know, the last 3 months, 4 months, 5 months, doesn't matter. You know, like this month, you know, what is this? It's high and low. Oh, this is an aggressive month, but still, it doesn't matter. You can still get at least an average over the course of time. You know, you can say, all right, 476 to 417, and then you got, you know, 454 to 407. You got, you know, 460 to 412. You know, you got, what is this? You got 456 to 409, right? You know, so it's like a $40 move. You know, this was what is this? This next one. Go to the next one. You know, high and low. What is this? 427 to 478. It's like a, you know, maybe a $50 move or so. You know, and then you can do that same thing where I just explained to you earlier in the video, where you know you take an average, take a sample size. I like to go with what's most recent, you know, just to give me a better gauge. You know, but the more you take a sample, the bigger your sample, you know, the better, the more accurate you can be. Because I like to take multiple samples, but you also have to, you know, keep in mind the environment, you know, and like the same thing on this side, right? Like you can do that, like if you were on this side of the chart, you can do the same thing. You can see how this, you know, how SPY moved every month, and you know, if you were to take an average of this, right, and you were playing monthly contracts on this, you know, based on this average move over time, like let's say you took a, I don't know, let's maybe you took this 3-4 month sample right here, right? This quarterly long sample, and then you played monthlies for that, you know, for these 2 years like that. You can see how you could have probably done very well doing that by using that measured move to give yourself an average, and then obviously using your own knowledge and understanding of supply and demand, macro and micro zones, etc. So hopefully that was, if anyone has any questions on that, feel free to ask. I'm gonna look at what you guys said, and I'm gonna go through that. If we have options expiring, say 10 end days put, and the move consolidates but goes up and now in a channel, does it lose value? Does it lose value come the expiration, even if it hits the target? Once it hits, okay, so once it hits the strike and it goes in the money, if it just runs, like let's just hypothetical here. I'm just gonna answer that question. Like let's just say, okay, here's a great look at that, right? So let's say you were targeting like a 410 strike from here, right? And you bought like a month of time, and you got to experience this whole move like that, and now you're up here and you're in the money, but then it just runs sideways like this and it doesn't go up or down or anything. If you keep holding that strike, you're gonna lose money, because the theta is gonna eat you up. Even though it's in the money and you already hit the target, the longer you hold that, the more that premium is going to dwindle. So yes, you would. Hopefully that answers your question correctly. I think that's what you're asking, Aaron. But yes, once it hits the target, if you continue to hold it and the price doesn't move and it just runs sideways, yes, you will lose money. Absolutely. Corey asked, how many DTEs am I talking about now? In my example that I was giving, I'm assuming you were talking about when I was giving the example in swing trading. So that's a good question. If I was expecting, like let's say I wanted to get that's a great question. I'm looking for an $18.5 move, right? I'm looking for an $18.5 move, and I'm expecting it to occur over a week. Me personally, this is me personally, I'm not going to give myself just 5 days for that to occur. I might give myself 7 days, 9 days, 10 days, you know, because every single trade, I always, you know, obviously I think that I'm going to be right. Otherwise I wouldn't take the trade in the first place. But you have to account, this is my opinion. I like to always account for things that, that could, you know, catalyst, like something could happen. Okay, like this, for example, here, maybe I went long here in demand, right? And on my way back up to 390 plus, Apple delivers some news in the middle of the day, and we have a 10-point move against me, you know? So I like to buy a little bit extra time just in case it takes a little bit longer to get there, you know? So if I'm here at 372 and I'm making a run up to 390, and we did 1, 2, 3, 4, 5 sessions to get there, you know, this could have taken 7, 8, 9 sessions. It's totally possible. So I like to give myself a little bit more time in terms of expiration, just so I can, you know, give it time to breathe. You know, I'm not going to be super tight. If I'm expecting an $18 move in 5 days, you know, I give myself a little more time just in case it takes 6 days or 7 days or 8 days, you know, or 10 days. So I typically will go like, 2 weeks, maybe, something like that for that big of a move, like a 20-point move, you know. And then in between, I'm also day trading too. That's my personal style. I like to day trade on top of my swings, especially like let's say I was running a long swing like this, right? But we had a short day in between my path, right, and my trend, right? I'll take that short in the middle of the day and still keep my long open, potentially, right? It just depends how much time I got. But let's say I opened this long here and I was running it for 2 days and I get this short move against me, no problem. That's okay. Yeah, the long call takes a hit, but I make up for it on the short side, you know. So I don't mind. It's no big deal. It's not gonna hurt me. In fact, this short move made more money than I did on the 2 days holding the longer call because of how aggressively it moved. So, sometimes I'll even compound the trade. This is just like my personal style. Maybe I'm in the middle like this. Like I ran a swing from here, from the top. I entered here, entered again here, entered again here. I ran a swing, a week-long swing, but I day traded this move, I day traded that move, and I day traded this gap down too overnight, and then cashed out my swing on top of all of that. So I day trade on top of my swings, because I do both. I swing and I swing in case I swing in case I'm wrong on my day trade, and I also day trade on top of my swing in case I'm wrong on my swing. So either way, I have an outlet to win. You know what I'm saying? So that's why I do both. So. You guys have any questions? Feel free to answer. It was about like 30 minutes of me talking pretty much nonstop. Yes, if you don't, all right, if I can't sit and watch all day and day trade, is it best to look at 10 plus trading days? Yes, absolutely. If you don't have the time to sit there and look at the charts all day long, then yes, absolutely. I know you're new here. I know you just got in here today. I recommend to everybody that they should be a swing trader. Everyone. Day trading is extremely difficult. It is extremely difficult. It's very mentally taxing, and it's very time consuming. And it's honestly, it's not for everyone. It's not. It is not for everyone. In fact, I think it's only for maybe like less than 10%, maybe less than 5% of people actually. But yeah, it might even be less than that actually have the time, emotional, psychological, and mental fortitude to conduct themselves in a manner where they can be successful at day trading. And that's not even my opinion. That's statistically. So, but now, if you want to look at swing traders and look at like the stats on swing traders, they're much more successful because they're not trying to time the market. They're just spending time in the market. And as long as you manage your risk appropriately, you are able to identify and execute on an edge effectively over a series of trades using leverage and probabilities to your advantage, I think that you'll be much more successful. Period. You simply will. Yeah, that's good, Corey. Yeah, you want to swing trade 5 to 30 days? I highly recommend that. I think you'll do well at that. It's and you will learn how to do that in here correctly. So, and this lesson that you just sat through is part of it. It's a major component here. So yeah. Yeah, I like that, and that's also why I swing trade. Like I said, I swing trade on top of my day trades. I'm not always perfect on my day trades. I often do well, but like I just had 3 sessions back to back with 400% trades, across SPY. But it's not every single day that I'm gonna do perfect. Some days I end the day and I'm like, oh dang, I lost 30% of my position. It happens. But if I have a swing in play, the swing, stops me from wrecking my portfolio, from wrecking my account. Because if I'm wrong, maybe I don't know, let's say instead of having 3 great days of 400%, maybe I had 3 days of negative 50, negative 50, negative 50% on a position. So that can happen as well. Yeah, day trading is very difficult, man. It's I think honestly, this is what I think. If you cannot swing trade effectively and consistently and do well at it, you have no business day trading. That's simple as that. Because if you cannot identify flow and identify macro and micro zones on a long time frame, you're definitely not going to be able to do it on a short time frame. You're not going to be able to. It moves too fast. It moves way too fast. So I think everyone should start out as a swing trader, and if once you can actually do that, and you can have a month, 2 months, 3 months consistent in the green, doing well at swing trading, then you can say, you know what, I'm gonna day trade. The problem is that most people they're impatient. They're impatient, and they look at trading like honestly, I understand it though. I understand it, but it's not correct. We all of us in here, anyone listening to this recording, and anyone in here that's listening to me talk live right now, we all know inherently that if you want to do anything that is very difficult and very complex, it takes hours and hours and hours of practice. Kobe Bryant didn't become Kobe Bryant overnight. And it would be foolish for all of us to think that we could go into the NBA and say, you know what, I'm going to be as good as Kobe in 1 month. We all know that sounds stupid, right? We all know that's not possible. So, but the thing is, for some reason, people think that they can enter into the most treacherous, difficult market in maybe in the world, right? And be a Kobe Bryant in 2 weeks. No, that's not how that works. It's gonna take hundreds of thousands of hours of practice and studying and refinement to become effective and become talented. And then build up the skills necessary to do this correctly. And so not only do people, for some reason, people think they can do it with money, and the odds say that you probably won't. And that's not to be pessimistic. That's just the reality of it. And and that's why I think you should give yourself more time to refine your craft, and also more time in your trades, because maybe you can sit in a trade and you can look at something like this and say, you know what, this thing's been moving down in my favor for 5-6 days, but now after 2 days it's not, and maybe I'm wrong, like, or maybe I'm wrong, or it's been moving in my favor for 7-8 days in a row, but now it's starting to get flat up here at the top. Maybe it's time to exit, and you have a little bit of time to think about that. And that's the beauty of swing trading, is that it gives you time to think. That's like one of the hardest things when it comes to trading, period, is the psychological aspect of it it can be so difficult for so many people, because your emotions get tied into it, and when your emotions take control of the trade, you can really have a tough time. So I just encourage everyone to take longer time frames on their trade, a week, 2 weeks, 3 weeks, a month, 2 months. Maybe as a beginner, you don't take a single contract that has an expiration that's longer, that's any shorter than 3 weeks. The longer the better. What I'm here to do is to teach you the fundamentals and how to understand the market mechanics. Yes, you can follow my trades, but also understand that my specific trades are they carry a much higher risk tolerance. That's why I'm doing them. But I've structured myself in a way, and I have the skills and risk management ability to, know when to hold them and when to fold them. Know when to add and when to subtract. Know when I should, know when there's a big catalyst like something like this. Okay, I can go heavy. And know that when it's choppy and dicey up here at the top, okay, maybe I'm gonna go a little lighter and be a little more patient. So, that comes with seasoning, and that comes with practice, over time. So, give you guys a second. If you have any questions, feel free to fire them off. I see Corey's typing, so I'll give him a second to go ahead and talk. Can we look at SPY some more? Sure, absolutely. Yeah, we're looking at SPY right now. Okay. Yeah, that's fine. Answer. Go. This is what it is. It's Q&A. It's just an open forum. You can ask questions, and anything that anyone's gonna ask in here, honestly, is gonna be helpful for pretty much anyone in here, most likely. So go ahead and fire away. Can we look at SPY some more? I have August 19th, 360, 370 puts. I bought before the close on Friday. Okay. I don't know how to do TA yet, but know the market's heading down. Okay. Yeah, I agree with that. Yeah, I have a 370 target in mind for SPY. I didn't enter any really long puts on SPX or SPY yet. Even though I wanted to get a little more confirmation into the week, because me personally, I think that we could range up here like this, for a few sessions is possible. So I didn't take it yet because I want to see more confirmation. I want to see it break down out of this supply zone up here. I want to see it push back lower. But if you got a 370 put for 819, you're probably going to be fine. There's going to come a point. It's most likely going to be this week. It's really hard for me to see it would take something. It would take something dramatically positive for this price to move against you at this point. It would have to be something, substantial. And you'll know if and when that occurs. It's going to be a catalyst. But with all the earnings that we have coming up this week, and all the major economic catalysts that's happening throughout the week as well, FOMC, GDP, blah blah, oil inventories, jobless claims, yada yada. There's so much going on. It's really difficult for me to see an overwhelmingly positive shift. So there's going to be a point between now and 819 where most likely both of those positions that you bought on Friday are going to be nicely in the green. And then at that point, you just need to set a profit target of where you want to take your profits at. Whether you're taking it down here in the micro supply, maybe you're taking it down here at the demand level because maybe perhaps you're anticipating, one more bounce against you, which is, very probable considering how strong this line has been for a month now. So, there will most likely be a point in time over the next, you have 3 weeks. You have 3 weeks for those puts. So you got plenty of time, and the theta is really not going to start hurting you big time for another 2 weeks anyways. So, you should see a nice move in your favor. And, me personally, like if I was holding that position, because I plan to join you on a similar position, I'm just waiting for more confirmation. But if I got a move down towards 380 and definitely at 370, a $20 move in my favor, I would consider taking those profits and call it good. Or at least if I had multiple contracts going, I'd at least clip one off right here in a known BFI footprint level. I'd maybe cut 1 or 2 off, however many I had. I'd cut a couple, and then maybe I don't even know what those contracts are going for. They're SPY, so I think they're only like maybe a couple $100 right now. Something like that. Just curious. So that's actually another point actually I should bring up as well. It's good to always, whatever you're trading, 144, 255. Okay. Yeah, I was just curious what they closed at here on Friday. Yeah, okay. Yeah, you're right on the money. Yeah, so they're a few $100. So like if I was trading that, I might have if I was on the 370s, I might have 9 contracts, 12 contracts, something like that. If I was doing a swing like that, and then maybe after I got a 10-point move, something like that, 20-point move in my favor, man, I'd probably cut, a portion of that. And then if I got another move in my favor, like this down here to 370 to this demand zone, I'd consider, trimming the majority of that in anticipation of a potential bounce. If it broke through that, finally, if it actually breaks through and holds, then I'd go back in and run it again and run deeper on the 360s, something like that. So, but that also brings up a great point. I'm actually glad that you mentioned that. One of the major things that I think everyone should do, and this is one for your notes. You should write this one down. You should write this one down. This is a big key here, because it is the number one reason why traders fail. And I'm going to give you a really simple way to alleviate this failure point, at least in one way that has been very helpful for me. And it seems so simple, but most people don't do it. Anytime you take a trade, any trade, doesn't matter, take at least, and you guys are beginners, take at least 2 contracts. 2 contracts, at least 2. If they're too expensive for your risk or for your profile, your risk profile, don't trade that ticker or that strike. If it doesn't fit the parameters that you need, maybe you want to trade SPY and you want to trade the 370 contract, but the contracts are, like he just said, they're $250, and you only got you got a $5,000 account, and that's 10% of your account to take those 2 contracts. Okay, maybe that's not a good ticker for you to play for that deep of an expiration. Maybe you should play, maybe AMD, right? Where maybe you can get, 2 contracts at $100 a piece, right? Something like that. Maybe you want to go, you want to go 819, and you want to aim for a deeper strike, something like that. Maybe you want to get a cheaper contract, or maybe you want to go for something like Ford, or Lucid, right? Where you can get into these contracts that are relative, that are valid, right? And, it's trading at $13 at the close. Maybe you want to take a 12 strike or a 12.5, and that fits your profile better, fits your risk profile better, and you can go for this strike here and build a few contracts in. Now, why take at least 2 contracts? I'm going to tell you why. Because the reason why you want to take at least 2 contracts, it doesn't matter if you're day trading, you're swing trading, doesn't matter. The reason why you want to take 2 contracts is because 99.999% of you are going to be greedy. You're greedy by nature. When it goes 100%, you want 200%. When it goes 500%, you want 1,000. When it goes 1,000, you want 2,000. And the problem is, what ends up happening, and I saw this happen on Friday in our live session, I kept telling one individual in particular to cut his position and take his money and go home. And let's look at what happened. Look at this. He has an entry here at the top of the chart, up here at 90. He's targeting the 87 strike. Now, if you've ever played a 0DTE, you knew what happened if you held this strike here into the close, because where did we close? At $88. It ran all the way to 87 and it turned around. Now, he could have sold these contracts for a few $100%. I don't know, maybe, I don't even know how much he made on them, or how much those percent was, but there would, at least at some point, those contracts were up at least 100% minimum. And most likely they were up 250, 300% on a move like that. A nice, healthy, $3.50 move right to the strike. So, but if you held those all the way into the end, you did all this patience work, and then at the end, it does this little move against you. That small move will absolutely kill those contracts because they're on a 0 DTE. Now, if you have at least 2 contracts like I'm recommending to you, what you can do is, if you're greedy, like 99.99% of most traders are, you can let one contract go 150%, let's say, something like that, and you say, you know what, I'm at 150%, I'm going to go ahead and sell that contract right there, and at that point, no matter what happens, even if the other contract goes completely worthless, you're still going to bag 50% for the day. You're still going to be up because you took 150%. You're still going to take a nice, healthy gain on your trade. And if you want to gamble and you wanted to take it lower, in anticipation for a bigger move to the downside, you could then, you could let it run. You could let one run. But at least if you have 2, at a minimum, as a beginner, if you have at least 2, once one gets a nice, healthy gain, take it off the table. Take one off the table, and if you're feeling, you like it's going to go more, let the other one run, and you let it run risk-free. Risk-free. Because no matter what happens at that point, you cannot go red on this trade, or at least trail a stop limit on one, trail a stop on one contract, at a, that taps it out at 150%, 120%. So even if you are complete donkey and you want to let the trade go red against you, at least you secured one at 125, 130, 150% on your day trade, and you can let the other one run. And even if you lose 30, 40, 50% on that one, you at least secure a nice gain on it. So that's something that's very important for you guys as beginners. No matter how you're trading, whether it's day trading, swing trading, whatever, doesn't matter. Even if you're running your swing trade like Corey just mentioned, he said he has a 360, 370 strike. Okay, good. You get a big move, let's go back to SPY. Let's just say you bought these on Friday, right? So you're at 400. Maybe it makes a run down to 380 or 370, let's say, in your time frame. You got 3 weeks to get there. So maybe it makes this move for you like this, okay? Maybe it makes this move all the way down here to back to demand. And let's say 8.5 is that Friday before. So maybe it makes this move for you over the next 2 weeks, and you have a 370, 360 strike. Your 370 contract is going to be very excited by the time you get over here back down to demand, because it's very close. You could cut those 370s off, secure that profit, and if you feel like you wanted to get more out of it and you said, you know what, I think it's got potential to make the run back down to the yearly low, you can let the 360s run risk-free. No stress to you because you've already secured the profits on the 370. You're already up, 150, 200% from making a move like that. And the 360s are, you're feeling lucky. And you're like, all right, I think this time, after 83 touches of this 372 level, I think this time it's going to finally break and go down, and I'm going to maybe secure a big gain on the 360 contract when it breaks through this yearly low and exposes this liquidity pocket, which is down here underneath this low of the year, okay? So you could do a setup like that. So, and that's, highly effective, and that's also why I recommend you guys take at least a couple contracts. And if it's too expensive for your personal account because it puts you over leverage, the contracts are too expensive, trade a different ticker. That's it. Trade a different ticker. You don't have to trade SPY. You don't have to trade Microsoft or Nvidia or Google or Amazon. If they're too expensive, trade something else that runs in line with it. You can trade a lower beta stock, something with a little bit cheaper contract price that can, that fits your account. Shredder, I'll see you tomorrow. All right, have a good night, Shredder. Look forward to seeing you in the morning for our live session. Okay, so that's something important. You don't have to trade the Teslas. You don't have to trade these high beta stocks with big contract price if it doesn't suit your account. Don't trade SPX if it's too expensive. You can't buy 2 contracts with it. Trade SPY, because the contracts are cheaper. You know what I mean? So, don't trade Tesla if it's too expensive for you. Trade Rivian or Lucid, you know, um, etc. So, I see Corey's typing, so I'm gonna let that question come in. For SPY, on a hard push down to low 380s this week, do you cut any or hold until it goes lower, thinking that it will go lower? Well, it's probability. You don't know it's going to go lower. You can assume, right? If we it's every trade in my book is always an if then trade. Okay, that's why I have these. I have a lot more lines up here because I'm day trading in this zone right now. But ultimately, I'm only really focused on a few price levels. I'll just clean this up here. Let me just move some of this stuff off the screen so you can just give you an idea of like where I'm really focused. You get an understanding. In my view, okay, everything is always an if-then situation. If it breaks through this 392 level and doesn't bounce again, I will expect it to go back down to this supply zone. If it can break through this supply zone where this big BFI footprint was present, I will expect it to go back down to this demand zone. But if I'm trading during the intraday and it comes back down into this micro supply, and it were to have a bounce, I'll cut that position right away. Okay? Because there could potentially be a nice response here, like we saw from this BFI footprint here. So, but every trade for me is always an if-then situation, and that's why we use zones. I know you're new here, but you're gonna need to go watch my videos on zones, and you'll understand why we use them and how they're used. Because your zone, okay, gives you your values, and those values are your entry price, your take profit price, and your stop loss price. Okay, so those are the values that of how you're gonna operate in the environment, in the trading environment. Okay, so like this, right? For me, I'm waiting for a hard break under this 392 and hold. If it were to make a hard break under the 392, then I'll take the swing trade and run it in with anticipation of going to 382. My stop price would be a reversal back up above this zone. If it were to reverse back up into this zone and hold, then I would take that loss and I'll cut the trade because I'll anticipate it to make another run back up to 397. But if it were to break this zone and hold lower, if it were to move under 380 and hold, I'll take that move. I'm only trying to capture 80% of the move. I don't care about the whole thing. I'm only trying to capture of this whole move. Let's say it goes from 400 to 380, right? That whole move, I'm only trying to capture this much of it. That's it. That's all I'm trying to do. I don't need the whole thing because I rather have the confirmation. That's me. That's how I trade. I rather have the confirmation. I rather miss a few points, and because I'll day trade these. I'd rather miss a few points on my swing trade, and I'll day trade it, no big deal, and have the confirmation, so I can take a nice move. I can take a what is this? From 392 to 382. I can take a 10-point move in my favor, and I can exit that trade happy. And if it were to break lower through this zone and it had a really aggressive price action, I say, okay, cool. Then I get to capture this much of the zone or this much of the trade. And I'm trying to capture that section. And I miss out on this top part, right? I miss out on this. But I'm missing out on it on purpose because this, to me, the way that I observe the market in this current condition, where it is, I can see this price potentially doing this move a few sessions in a row. So I rather wait for the confirmation of when it's exiting that level. Okay, when it's exiting, great. Then I'll get to enjoy the moving down. And if it exits this level, which it would most likely will, if it exits this level, I'll get to enjoy the rest of that move. That's what I would anticipate. And I'll use these levels as potential stop loss. Like if it were to, let's say, make a move, something like, let me clean this up a little bit. I don't like having so many lines on the screen. You know, let's say I'm in the trade, and that's why we use zones. Let's say I'm in the trade. It goes like this. It exits the zone, right? And it goes, it goes to here, and then it reverses back like this, right? After it exits, I'm gonna exit this trade. I'm gonna get out because that means maybe it's gonna go back up. I'm only gonna re-enter once it goes back underneath, or maybe it's maybe it makes a move, something like this and gets close to it, like kind of kisses it and then goes like that, right? I'm gonna exit that trade. I'm gonna exit it right there, and then I'll wait. I don't mind if I exit a trade here and then I miss out on this movement to the downside. I'll get back in when it makes the break underneath and take this move, from here, from here to there like that. I'll gladly miss this section here. I'll gladly miss that section like that. No problem. I have no problem missing that. That's okay with me because I got to enjoy at least 8-9 points of that move going that direction. If I miss 2-3 of it, I don't care. No big deal. Chaudhry, thanks for putting that in here. That's helpful. Using leveraged ETFs is another great way to do it as well. You don't have to trade options. You can even trade a leveraged ETF too, where you're not going to be bound by time. So that's also another great way to do it. I see your break below your level. What expiration would you look to pick up? So remember at the beginning of this video, that goes back to our measured move. 1 second. Okay. I'm gonna answer this one last one because I actually am gonna have to get out of here. What expiration would I look to pick up? Remember, I'm expecting SPY to make a $5 to $7 move in one day. That's a normal price movement for me, and I'm gonna give myself extra time. So if I'm down here and let's say I broke through this zone, right? I broke through this zone. I got really nasty catalysts happening. Some like FOMC's bad, earnings are bad. I'm gonna judge the environment too. That's gonna weigh my decision on what kind of expiration I'm gonna take. But let's say it broke through this zone and then just a regular environment with nothing too crazy going on. Let's say it broke this zone. I'll probably take at least a good 7 days, minimum for it to make that move. 5 days at least to go from 390 to 380. That's me. That's how I would do it, on a smaller move like that. On a bigger move, something like this, like if I was going for like a 20-point move, give myself a few weeks, man. At least three weeks or so to get like a 20-point move done, 4 weeks. Yeah. But like I said, I'm very, very open to risk. So, I'm giving you like a safe timeline, but sometimes I'll tighten it up. It just depends on the environment of what's happening. So, but yeah, I actually have to cut this one. I can only do an hour with you guys tonight, unfortunately, because I have scheduled plans tonight. So I'm gonna have to cut this video for now. Hopefully you guys were able to get some great information. I recorded this session. I'm going to upload it to YouTube for anyone who missed it. And if you wanted to review it, I feel like this was a really good lesson, a helpful lesson for you guys. And I'm sure it'll be beneficial for you guys in the future. If you have any other questions, feel free to put them in the general chat. I'll be happy to answer them later, when I get back from my event this evening, because I'm going to be online charting, etc., and doing my regular due diligence like I always do. So, anyways, I appreciate everyone coming in with the questions. Good questions tonight. And, I'll talk to you guys later if you're on. Yeah, put them in the general chat. Yeah, Yeah, put them in the general chat. I'll always answer your questions there. Put those in the general chat, and then I will either catch up with you guys later tonight if you're online, or I'll see you in the morning for a live session. So, all right. You guys have a good evening. I'm going to go to my event now. Take it easy.